Thanks, Tim, and it's great to be here today. And congratulations, everybody, for being part of this program. Had the pleasure of addressing the group last year, and I think it's a great thing what you're doing, so all the best for how it works out for you. Tim's given a great introduction, thank you, and I won't sort of hark over some of that background, which is a bit summarised there. I did want to touch on very briefly with one of my passions at the moment, which has got almost nothing to do with what we're talking about, but it's the regional incubator that Tim just touched on, because I think everybody should know about what's happening. There's a group of about 25 organisations in the Hunter that are involved in trying to formulate a regional incubator to help innovative enterprises in the Hunter. And at this stage, we're at the point of being able to appoint what we call an expert in residence to help us design the system, and also to help 15 companies or innovative enterprises to be able to go through the process of being investor ready and develop. So we're expecting to appoint that expert in residence in the next month, and that expert in residence probably will take about 3 months to formulate a structure for the organisation in consultation with organisations around the Hunter. And so after that, we're hoping to make an application to the federal government for funding to get this thing going. And it's going to be like a virtual incubator in the sense that we're not going to have probably a physical space for the incubator. It's just going to actually coordinate a lot of stuff that's happening already in the local area in this space. There's a lot of organisations doing great stuff, but there's also a lot of spinning of wheels happening, and it's very uncoordinated. And so the idea is that we can coordinate that better, then we can help both established industries in the innovation space as well as start-up and early stage to do a better job. So if any of you have got any great sort of innovative ideas and you're wondering about the way to go about it, the Hunter Incubator will provide a much more effective way in which you can develop your ideas and commercialise them and find capital and all sorts of things like that. So today I'm going to talk about the concepts of capital raising for startups in early stages. I'm talking about that because I know a lot about that space, having been involved in angel investing and connected with that. Also in my legal practice, I get involved with further stages of capital raising as well. And I could talk about that, but today's focus is much more on startups in early stages. A lot of the principles that I'm talking about today, I think, have application for beyond startups in early stages. Some do, some don't. So keep those sort of concepts in mind. As Tim mentioned, I have been involved with Hunternet for many years. I was on the business value group of Hunternet until a year ago, just involved in helping businesses to think about the ideas of what makes their business effective and what the problems that they challenge and face. So a little bit like, I think, the sort of problems that you would confront in this course. So why angel investors? So for those that don't know, an angel investor is really just somebody that invests in early stage or startup innovative enterprises. And so the obvious question is why bother going to angel investors? And just by the way, Hunter Angels, as mentioned, we have 26 investors within Hunter Angels, and some people within that group have quite a capacity to make quite an investment for the right opportunity. So we are a credible group of people that are looking for good opportunities to invest, and we do make regular investments. So angel investors are essentially risk capital providers. We know that this concept of early stage investing is a risky area, and so we're used to the concept of risk and trying to assess it, and also the concept that maybe sometimes you lose your money. And that's, I think, an important principle for anybody looking at trying to do a startup or early stage, and that is many of them don't work. And it's okay to sort of fail because that's really part of the process. You hope not to. You hope to make a big success out of it. But the whole area is, if it does fail, well, you learn something out of it, you pick yourself up and you move on. And hopefully you try another one and the next one might work. And if that fails, well, if you've got enough perseverance, the next one. So So sometimes people that have been through those sort of processes are the most attractive prospects to invest in, because you know that they have had their hands dirty with the process and they've learned a lot through the process. If you make an assessment that they're not learning through the process, well, you know, maybe you don't invest. But if you do feel that, well, actually they did make a mistake, or maybe it wasn't a mistake, maybe they just didn't know how it would go and they gave it a go and they failed, well, that's okay. You've learned something hopefully along the way. So angel investors are comfortable with small equity shares, so we're not looking for 50% or more, or even 40 or 30% equity in businesses. We're often quite happy with 10, 15%, something like that, because we see that the founders of the business are the ones that need to drive the business, and they need to have the most at stake to be able to make something of it. And we have knowledge of startup challenges and risks that we can help through that process and give some ideas about some of the challenges and things through that. So a little bit of hand-holding that happens. A lot of the people within, almost everybody that are participants within Hunter Angels, have a high degree of business skills and are able to provide good mentorship. Some of them, you know, really have been captains of industry, people that are well known in the Hunter for people that have built businesses. And so a lot of that is available for people that may come to Hunter Angels for money. And we have contacts that we can help. You know, contacts could be in finance, it could be in opening up markets, those sorts of things. And I like to think a bit of credibility with the group as well, given the nature of the people that are part of the investor group. I think there's some good names there, I might say, in the group. We're comfortable with co-investing in the sense that often we don't have sufficient funds to be able to provide you with all the needs for the business, so we'll co-invest with others. We have connections with groups like Sydney Angels and other angel investing groups around Australia, but as well as that, other sort of venture capital type groups, and of course we're always happy, Tim, to liaise with the banks and others in getting the right structure right for financing. So, and also we feel that just going through the process of engaging with Hunter Angels is that you become pitch. There are benefits in doing pitches of your opportunities to Hunter Angels, and the due diligence process that we ask people to go through, even if there isn't an actual investment. So the pitch process is really important to us. The pitch is obviously the founders standing up and selling their opportunity for people that may want to invest. And we find this is an incredibly important part of the process. Tonight, I've got to leave early this evening, unfortunately, but tonight we have an event, a pitch event. So we've got 4 companies presenting to us, and we provide those companies with just 10 minutes to stand in front of our participants to basically try to convince us why we ought to be investing in them. And you might say, well, 10 minutes is a very short period of time. Well, it's what they call the elevator pitch. You know, you get into an elevator with somebody that you know might be interested in what you've got, and you've got a few seconds to convince them that what you've got is worthwhile thinking about. And I'd like you to think about that concept, because it's a very powerful concept. If you've got an idea and you want to convince others that it's a brilliant idea, you have to condense down what you have in very simple terms in a way that most people can understand, and which convinces them that this is a good idea. We get hundreds of opportunities that flow through us all the time, and we can't afford to just indulge in you know, rattling on for an hour on why this is a great idea. If we're interested, then we can sit down with you and talk for an hour or so. And maybe it's a little bit similar to banks, Tim, you know, in the sense that if you go along to a bank and if you don't have your act into gear and you can't tell a story within 10 minutes as to why the bank ought to be wasting their time with you, then maybe you haven't really condensed down really what the deal is and why the bank ought to be listening. So, so what do angel investors look for? Well, first thing is that you have to be investor ready. You have to have all your ducks lined up in a way that it's attractive for people to say, yes, I can invest in that. And that might sound rather basic, but I would say like 90% of the prospects that we look at are not investor ready when they first come to us. You might think you're investor ready, and we might say, well, what entity are we investing in? Oh, well, maybe I don't understand that. Or, okay, well, tell us when you're ready to say what entity is we're investing in. Where's all your intellectual property held? Oh, well, I hold a bit and Joe Blow holds a bit, and well, we're not interested in that because we want to invest in the IP entity, so you need to get that house into gear. So those sorts of issues pop up all the time. The idea product or service must provide a solution to a real problem or issue in the market which is verified or verifiable by the market. And those concepts are underlined, they're real and verified or verifiable, in the sense that we get a lot of opportunities that come along that people say it's a fantastic opportunity, and they almost sort of say, well, it's self-evident that this is a great deal for you. Why aren't you throwing large amounts of money in it, and my company's worth $20 million because it's just such a fantastic idea. Now, I suppose a good example that I would give, and I often give, is the perfect mousetrap. Not that we've had one presented to us, but just think about this. Somebody comes along with the idea for the perfect mousetrap, and they look at it and they put it in front of you and they say, this is a brilliant mousetrap. Everybody can see that it's a brilliant mousetrap. And it's just so much better than anything that's out there at the moment. And all we need is 0.5% of the world market, and we'll all be multi-millionaires. And we're just asking for $20 million, a value for our company of $20 million, for you to be part of it. You put your 200,000 or 300,000, and we think the company's worth 20 million. So that means our percentage is very small on that risk, right? And then we say, well, how do you know that it's the perfect mousetrap? And they will say, well, my friend said it's a perfect mousetrap, or it's self-evident, isn't it? It's a perfect mousetrap. Everybody can see that it's... And so the founders get really wound up with their idea. Of course it's a brilliant idea. They need to be passionate about it. But from our perspective, though, it's not a perfect mousetrap unless the market is saying it's a perfect mousetrap. And so what we look for is that, well, first of all, it's got to be a real problem. Do people actually need a different mousetrap? And is the market saying that there is a need for a solution? And secondly, even so, can you verify that what you have is something that the market actually is prepared to buy? So we'll often say, people will often say, oh, well, this company said they might buy, and if you get your act together. Well, that's of some comfort, but we all know the reality of the world, that really until you have a product available and people are buying it, then you've really proven nothing. You're proving that there may be an interest, but you're not actually proving that there is a market demand for it. So, of course, the more you have an established market, the better confidence we have about the viability of a business. And you might say, well, that's all very well, but then the company's worth a lot more. And that's true. So the more established it is, the less risky it is for us. And presumably then the value of the opportunity rises as well. So you usually get that trade-off. The less proven your business model, then it follows that the lower the value of your business, so that when we invest, we expect a higher slice of the pie. So it must be scalable. We typically look at something that has to produce at least a 10 times return on our investment. And you might think, well, that sounds like a pretty outrageous figure. It's not, because the model really requires it. The thing is that international studies say that angel investing is very risky, and that for, say, every 10 investments you make, probably 5 or 6 will fail, or you'll barely get your money back. And another 2 or 3, you might just make a small margin on it, and 1 or 2, you hope, will do very well. So just look at the mathematics. Unless you've got that 1 or 2 that are actually returning you something like a 10 times return, then it's not going to be worthwhile you doing it. And These are very achievable though, these sorts of returns. You've only got to look at many startups that really start off with very little and then propel to something quite large, and it does happen. And we have some investments that we've made that have that potential to do that. And we haven't had an exit yet, so we can't count any of our money, but we're trying very hard. So, yeah, sorry.
Do you set a time frame on it, or is it sort of
Yeah.
business specific?
Well, that's a very, very, very good point, because one of the things we always look at is what is the exit strategy, both for us and for the founders. And that needs to be made clear right from the start, because most of the founders have an interest in doing something as a livelihood. They might be happy to be doing it in 10 or 20 years' time. A lot of the investors, we're all getting on a little bit. 10 or 20 years' time was a long time for us. So, that issue about the timing is very important. We try to have those discussions right from the start about what is your exit strategy, etc. But what we find is that you can actually have some idea about what your exit strategy is, but until you go down the track a little bit, you don't quite know what the exit strategy might be. And so that's an ongoing challenge. It's a big issue. So a lot of businesses are scalable, a lot of businesses are not. And so there might be a proposition to invest in your local fish and chip shop, which is not an innovative type opportunity we'd be interested in. But statistics say your risk of investing in the local fish and chip shop are probably just as high as investing in a company that has an opportunity to bring you back a 10 times return. And this is a very important principle looking in this space. So if you're looking at these sorts of opportunities or trying to build something yourself, think big, think blue sky, think about the opportunities about how this could be scalable into something that will give everybody a 10 times return. And if it's a credible idea, that's a much better idea, and without offending any local fish and chip shops, but that's a much better idea for an opportunity if it's got that opportunity to scale up into a 10 times opportunity or 100 times or whatever it might be. So we look for a rigorous, well-researched business plan. We want confidence that you've thought about the issues and can adapt to that. The quality of the founders is fundamental. So we've made an investment in a company based in Wollongong where the technology itself is not really all that well beating. I'll tell you what it is. It's a group called Critical Arc, and they've developed an app on your phone used mainly for university students and things on campuses that if they run into an emergency, they can press the app and security will know exactly where they are on campus and can mobilise health or safety type people to help them using GPS type technology. And you might say, well, that, in today's world, that's not really all that unique, is it? Yet that company, the people came out of Honeywell with a long background and knowledge of the area. They do have very good understanding and technology in this area. They've adapted various bolt-ons to that to make it better. So they stitched up a number of campuses in Australia. They went over to UK, they've stitched up, I think it's about 6 or 7 at the moment over there. They went over to USA and they stitched up, I think there are about 15 or so campuses over there. And now they're looking at that application into industrial applications and retail and things like that, because nobody has really done it the way they've done it. They've got the background, they know it. So it's a very good business model. And we identified the qualities of the people right from the start, and we thought we'll back those people, even if it isn't a world-beating technology. So market knowledge and focus. So it gets back to what I was saying before about the perfect mousetrap thing. They'll come along and sort of say, well, of course it's a great idea, but unless you've been into the market for mousetraps for a long time and you can give us confidence that you know that market, then we're not going to have a lot of confidence that you're really on top of the issues for the market. Ability to move beyond comfort zone. So nobody sees this area as easy. Nobody sees that that the path ahead when you get these things going is going to be easy. So we want people that are comfortable to move beyond their comfort zone to solve problems as they arise. we want the people with some credibility in their area and some industry experience, hopefully. So excellent communication skills are important. So it's a bit like what I was saying about the elevator pitch. If you can't articulate what you're doing and why it's a great idea for people to be involved, well, people won't have confidence to support you. It's not only the investors, it's the multitude of other people that you'll be talking with about your opportunity, whether it's the banks or whoever it might be. I'm not saying that these things can be developed, of course. Any of us can develop good communication skills. So, but just keep that in mind in that process. The angel money must be used for productive purposes. So we're not interested in putting money into an opportunity where the money is used to pay back loans provided by the founder, because where does the money go? It just goes back to the founder. It's not used to actually add value to the business. So we like the idea that we know exactly where the money's going, and that's for a credible purpose to build the business. And willingness to accept advice, not only from us but others. You know, some people that you know that you can sort of work with, you know, that they will work with you, because it is a complex area. Understanding of the competition, which sort of gets back a little bit to the mousetrap example I was giving before. You know, that you need to be able to convince us that you understand that nobody else has developed that mousetrap that quite solves the market problem the way that this has. And high barriers to entry. So one of the problems with the mousetrap idea is that unless it's a very unique technology, that probably a lot of the, you know, if you come up with a perfect mousetrap, others might be able to replicate that idea fairly easily, unless you can get some sort of patent protection for it. So obviously these traditional areas like patent protection give you some barriers to entry, but there are lots of ways you can get a barrier to entry to stop competitors being able to replicate what you've got. Some ideas are just so difficult to replicate. Sometimes it's the black box idea. Sometimes what you've got is in a black box. If you open the black box, you still don't know how it works. And because they might be based on algorithms, for example, that you can't really see if you open the black box. Or it may be you've got a store of industry knowledge that it's very difficult for people to replicate if they're trying to do it. So those things we look at about what are the barriers to entry, because obviously from our perspective, you may have the world's best idea, but if it's so easy for people to replicate that idea once it's out in the market, well then the value of our investment can very quickly disappear. So verification and ownership of IP. So typically there will be strong intellectual property, an innovative idea that's part of the idea, and it doesn't necessarily have to be registered. There's a whole body of law about the issue about whether intellectual property needs to be registered or not. But at least it's something that's protectable, and it needs to be owned by the entity that we're investing in. And this is a common problem that sometimes people say, oh, we'll just give a license to the organisation you're investing in. That organisation can have an exclusive license to be able to exploit the intellectual property, and the founders will hold the intellectual property somewhere else. Well, that's just not going to cut it for us. You have to look at it from the investor's perspective. They need that comfort that they're part of the intellectual property process. So capacity of angels to add value. So we're not interested in silent investing. We like the idea that we can add value not only with the money we can contribute, but by mentoring or some other areas that we might be able to assist on. And as mentioned before, exit opportunity, that idea that we need to see a path forward so that we can get our money out. And it's a very important business principle, and in the business value group within Hunternet, this was often talked about as well. If you're starting a new business opportunity, in my view, you should always have the exit in mind. And you may not necessarily carry out that exit, but it's a very important discipline in the way you do business, because it forces you really to look at the ways in which you can enhance the value of your business all the time. Because you know that in 12 months' time, somebody might come along and offer you $1 million for that business. And as soon as you start thinking that way, you start thinking, how can I add value to my business that makes it attractive for somebody to buy me out so I can go up to the Sunshine Coast and live there for a while. We look at making sure the equity investment is value for money, which really means if it's a high risk investment, we expect that we buy in at a good price because it is high risk, and that people are realistic about how they value their opportunity. Typically people it's understandable, but they overstate the value of what they've got, and they probably think it's worth what they're stating, but they don't really understand the risk associated with moving a great idea into a business model that actually works. The more down the line you are of that business model to say, well, this is working, you can see I've got $100,000 worth of orders already and I've got all these customers lined up to, all I need is more money to do it. Well, that's a lower risk, and obviously the value is going to rise accordingly. And then the last point there is sizzle, a very technical term. And sizzle really is the why do we do it? If we just want to try and make a return on our money, we'll buy some shares on the stock exchange. But the sizzle is all about, I like that idea. I like the people behind it. I like what they're trying to do, and I want to back that. I just like it. And I think that hopefully, if you're doing something, then you'll think about it as the sizzle too. Why am I doing this? I'm doing it because, well, I might make money out of it, but because I also believe in what I'm doing. And people relate to that. So how are we going with time?
Probably 5 minutes.
5 minutes. So very quickly, I can talk about legal considerations because that's what I do. So get the structure right in what you're looking at, spend some time on that, and document key legal relationships, whatever they might be. So it could be employment arrangements or it could be distribution arrangements and things like that, but spend some time on those. Where you've got different shareholders involved, spend some time on shareholder agreements that regulate how the shareholders are going to interact with each other and what they contribute or not. Convertible notes are being used increasingly with capital raising. What they are is that, well, there are a number of alternative ways you can invest money into opportunities. You could invest straight in with shares. You put money in, you get shares out. Convertible notes are more a loan that you provide, that give a promise that they can be converted into shares if certain things happen in the company. And typically it might be that if there's a major capital raising. So let's say the founders are looking for $100,000 in investment, but they look at 12 months' time, we want to raise $2 million. So the trigger to convert your loan into equity might be when you raise $2 million. And the sweetener for the angel investors is that once we raise $2 million, when we convert your shares into equity, you get a discount on the entry price. So it might be a 20% discount on the price that everybody pays for that big round. So the value of that sort of concept is that you don't have to worry too much at the start what the value is of your company. So if everybody's a bit unclear, well, what's it worth? What's this perfect mousetrap company worth? Is it worth $10 or is it worth $10 million? And you could maybe argue for ages. But if you are 12 months down the track and you've jumped all these hurdles about establishing a market for it, and you've got people willing to put $2 million into a company that they value at $10 million, for example, then that establishes a market for what you've got. And then angel investors think, well, if I can get a 20% discount on that, or whatever the figure is, then that sort of works. So convertible notes are good. Think about employee equity plans. There's been some changes in the last 12 months that make that much more attractive to incentivise employees. So if you've got a startup and you can't afford to pay employees the big bucks, you might be able to implement an employee equity plan that gives them a slice of the action and what you're trying to do. Intellectual property we've talked about. Get some great advisors to help you. People that understand what you're doing, this space, rather than just people that don't. But controlling costs is fundamental, and this is the big challenge. It's how do you do all this in a way that you're not going to spend huge amounts of money on it. And then, as we talked about before, keep the end or the exit in mind all the time. And I think I've already explained the value of keeping that exit strategy in mind. So that's it. Any questions from that? Any thoughts? Any arguments? Yeah.
How do you value a company?
Well, I'm not an expert in valuing a company, but it's a good question. When you've got an established market for something, an established demand for it, then, and a business has been around for a while, then the models for how you value a company are reasonably well recognised, and typically you look at what they call EBITDA, earnings before income tax and depreciation, etc., and create a multiplier from that. So, which the multiplier depends on the nature of the industry you're at and how much growth potential there might be. And so some industries might typically have a multiple of EBITDA of 3 times or 4 times EBITDA to establish a value. But others that are fast growing and big opportunities, like the IT space, often has much higher multiples. So it could be 7 or 8 or 10 times EBITDA. But those traditional models don't work very comfortably with startup and early stage, because often they don't have any earnings or very few earnings. And so it becomes very difficult to do a proper value. And that's why what I mentioned before about convertible notes, that sometimes it's just too hard. It sounds like a great idea, but how do you value a great idea when you don't have a revenue flow flowing out of it? It's very speculative. So your choices are to have a big discount on the price of what you think it's worth. You think this idea is worth $5 million. The angel investors think it's only worth, $500,000. So your choices are either to sort of say, well, I want this money in at this stage, so I'm prepared to give people a good opportunity to invest at this stage at $500,000 pre-money value, as they call it. In other words, the value of the company before the money comes in. So you basically say, okay, I'm prepared to do that, or you convince the investors to go to a convertible note idea. But the convertible note idea really only works if you have a trigger point later on where you can say, these are the reasons why it converts into equity, and this is how you might value that conversion. And so it's not an easy answer, but that's the best I can really do at the moment.
How innovative is the Hunter, and are the angels in front or behind?
Sorry, how innovative, sorry?
So in the angel, you see lots of innovation. So can you comment on how innovative people in the Hunter are generally? And if you had a dollar value, the angel invested X dollars, are they in front?
Yeah, okay. So the first question is that it is amazing how vibrant the Hunter is right at the moment. I am really, really excited about what's happening. There are so many organisations that are doing things, and so many people, and I've got to say more younger people, that are in this space right at the moment doing things. So you've got various hubs happening at the moment. For example, this morning I was at Dantier over at Charlestown. Dantier is the hub for the Lake Macquarie City Council, based in Ridley Street at Charlestown. And I went in there and caught up with them there, and there's lots of younger people all doing their thing, creating opportunities. You've got spaces like 1804. Has anybody heard of 1804? Yeah. So they're setting up. They were over at CSIRO, and they're now moving over to the TAFE building over in Parry Street, and they've got people falling over themselves to get involved with this hub. And it's also the university is doing things with their space over here in Hunter Street, with young people coming through the space there. So this is happening. When we started Hunter Founders Forum in 2006, it was the height of the mining boom, and it was a hard slog trying to convince people that you need to look at this. And now everybody's doing it. It's fantastic. As I said before, it's uncoordinated and all those sorts of things. We need to improve that, but it is happening. There's lots of great ideas. So the great ideas are not the problem. The part of the problem is for people to understand the process and to educate, and get their act into gear. But we as a region are doing better at educating people about the process. And none of us are experts. I mean, some of us have knowledge about the process, but I'm learning heaps all the time. We're all learning, but as soon as you accept that you don't know it all, we're all trying to learn from it, that's when you start to work with each other. And one of the powerful things about the Hunter Valley is how great we are at networking. Much better than, say, Sydney. Sydney, you get lost. Here, you don't get lost. If you connect with the right people, they'll work with you to find a solution. In terms of your second question, so we haven't had any exits yet. So we don't have money in the bank from our various investments. Our best yardstick is when other people put money into our investments at a certain price, and we will revalue our investments based on that entry price that others have put in as the best guide we have. So I would say that we are well in front. In terms of the actual percentage, and once again, it's a bit speculative. I'd say we're probably maybe 2 times or 3 times our investment. But remember that some of those investments go back 6 years or so. Yeah. And we don't have our money, so we're still at risk. But some of them have got great opportunity. We've been invested in Switched In. Anybody heard of Switched In? They're a local company that they're based at the 1804 hub, and they're going really well. Andrew Mears. So they've developed a device that integrates for solar panels for residential purposes. It integrates between the solar panels, the inverters, and batteries to give users, consumers, a much more powerful understanding of what's happening, and to monitor what's happening and to make decisions so that they save money the best they can. And they're rolling out, they're doing big estates around Australia and things, so that's a great one. Another one we invested in is a company that's now based in Silicon Valley called Vimoc. They did some trials locally on monitors up in Derby Street, monitoring traffic flows and pedestrian flows, and they have really unique software that allows at a local level to be able to digest data that comes in from these sort of sources and make sense of it so people can read in real times before the data goes to the cloud. And so they're working with groups like Cisco and whatever for, the sort of smart city concept that Newcastle City Council is all about. Newcastle City Council has used the Vimoc technology for that, but cities around the world are all looking at this space. So my belief is the next best opportunity right at the moment. The big opportunity really is how you use information technology in the local level to give people information about their day-to-day lives. And Vimoc's sort of part of that process. So I think they're a great opportunity.
That sort of leads on to my question. Sorry, I don't have my name badge on, and
Yep.
from Newcastle City Council.
G'day. Well, I hope I plugged Newcastle City Council.
I thought that led in quite nicely.
So Newcastle City Council are one of the prime leaders for the regional incubator. And
so
thank
that's
you.
what I was going, that was my question. The regional incubator is that, we had a session 2 weeks ago on public and private.
Yeah.
Is it a public and private mix in that incubator?
So
private and public organisations involved?
So right at the moment, the regional incubator is largely driven by major institutional organisations. Newcastle City Council is one of the leaders of it, as is Lake Macquarie City Council, the University of Newcastle. Hunter Founders Forum is going to be employer of the expert in residence, and there are a number of other organisations, Hunter Medical Research and Hunter Health, those sorts of organisations. It hasn't really flowed out much at this point of time to industry generally, because we just want to employ the expert in residence to do the process, and then when we complete that and have an idea and actually establish our hub, that's when we need industry involvement. So your various employers or whoever you're involved with, we hope that there'll be a lot sort of saying, yeah, we want to be part of that process. And so my view about it is either be part of it or miss out, it's because I feel it's going to be an opportunity.
Can I just ask a question? So I'm Sarah from Port of Newcastle.
Oh, right, okay.
I was aware of the Hunter Founders Forum I used to work for Colin Allied with Steve Sneddon.
Oh, yeah.
So I came across it back then, and yeah, like you said, it was, one of the first sort of models of its kind. So
we talked about when it was unfashionable. Yeah.
Yeah. So it's really interesting to hear. Yeah.
Yeah.
So my question was around. So you've got a startup. Is it is the money of more value, or is it the connections and the experience and the people that you can sort of connect them with? Do you think that, you know, one's more valuable?
Oh, well, I think that's a hard one. It depends on the circumstance, but let's face it, money is king.
Yeah, okay.
You know, money is what drives the capacity for people to be able to sustain themselves, to be able to employ others, to be able to invest in developing what they've got, you know, all those sorts of things that matter. So I probably am biased towards the money.
Yeah.
And really it gets back also to the point I was making before about proven market demand for something. Once you start getting money flowing through the door, then it gives you so much more power, not only to value your business, but to be able to do so many things to move your business forward. So as far as I'm concerned, money is absolutely king. Contacts are great, all of those sorts of things. They're the add-ons.
Yeah.
But really, I think in any new idea, whether you're in an established business or a startup or early stage or whatever, if you can't get the money right, well, you know, you're really not driving the business in a way that is sustainable.
Just building on that, so
Yep.
the people that you're seeing pitch in front of you, are they people that have put their own money in and developed it to a point where it's earning cash, or are it's literally just an idea?
Well, yeah, so it's usually much more developed than an idea. There are organisations around town, you might have heard of Slingshot, for example. Slingshot often gets involved in sort of that very early stage. It's just an idea they present in front of Slingshot, and will Slingshot help them through that process. That's fairly unattractive to us, you know, because it's so early stage and so high risk. Yeah, so they're really a little bit more developed.
Yeah.
So does that answer your question? Or?
It kind of does. I guess that the main thing that we're asking is, like, a lot of people, they obviously have a good idea, but they probably don't have the cash back and can start to really kick the idea off. What's the main source of seed funding?
Yeah, so often they'll do it through their own devices. We unkindly use the reference, and some of you might have heard it before, family, friends and fools. And this is not trying to sound pretentious, but there are a lot of people that invest in this space that really have no idea what they're doing. And it's very dangerous to invest in a sort of a high risk area if you really don't know, and you think that a lot of people go into it thinking it's a huge blue sky opportunity, and they get carried away with the opportunity. And so if somebody's sort of dragged in money from the family and the friends and people that really don't know what they're doing, then it tends to be a very difficult thing to challenge to handle expectations. As I mentioned before, angel investors sort of have an idea that we know that it's risky and it's hard work and all those sorts of things, and it might fall on its face. If you as a founder, I think it's better to deal with people that actually know that this could fail, because if you're dealing with people that have false expectations about the opportunity, what happens when things get tough? Do you want shareholders squeaking down your phone, ranting and raving because they're going to lose their money? Or do you want people to sort of say, okay, how can we solve the problem with you? Or if you fail, well, okay, we tried, you know, you did your best, let's move on. So it is an issue about it though. What you're touching on is how do you get to that level where you can get it to the point that's attractive for people to invest. Now, one of the things about what the regional incubator will do is to provide the infrastructure, and it's already doing it. There's a trial going on right at the moment of people being assisted through the process so that they can become investor ready and they can commercialise what they're doing. And a lot of this is being done on without charge to these people. So they can develop quite a sophisticated business strategy, often just spending their own time on it. Now, there are organisations around town that are already doing this outside the trial process. And so groups like the Business Centre are helping people, the Hunter Business Centre, and Slingshot's doing a few things. We help where we can, but we don't have quite the infrastructure like some of these other organisations. So there's a lot happening in this space. But I think the main issue here is what will happen when we get the regional incubator going. And so I think it'll be a much more sophisticated process of helping people from start through the process.
I've seen a chart at work that's got like the idea down the bottom, and it literally goes like that up to the support as you move up. So it's like the first few people like Slingshot and that supporting, and then the support keeps going. I saw it for a quick second.
Is that the mind map that you're referring?
Yeah, colleague's shoulder, and I was like, wow,
Yeah.
so we've got an idea, and then
Yeah.
the graph just goes like that.
So-
the support, different people that can support.
Yeah, Rob Olver of Oz Industry developed a wonderful mind map of all the various organisations in the region that are involved in this space, and there's a lot of organisations. It's sort of a bit mind-blowing when you see it, just how many different organisations are part of the process. So, as I said before, it's uncoordinated and fragmented. So my point is, how powerful is it once you just do a little bit of coordination? We don't have to actually try very hard to make a big difference, would be my message. And it is happening because the energy is there right at the moment to make it happen.
What's the background of the other members? What sort of various background?
Of the various members of Hunter Angels?
Yeah.
It varies quite a lot. Of the 26 people, first of all, we have a criteria that you have to be genuinely interested in angel investing and some capability to be able to do it. We expect people to commit to invest each at least $10,000 a year. They don't actually have to do it, but they have to be in a position to be able to do it. Now that's a criteria that knocks out a lot of people, because we think it's a bad idea if people invest too much of their investments in angel investing because of the risks that I mentioned. And so we'd say you shouldn't have any more than 5% of your net wealth in angel investing because of the risk. So if you do the mathematics, and if you're sort of having to invest 10,000 or so roughly a year or whatever, then it starts to cut out a lot of people ordinarily. So it tends to be people with high net worth, and also people that have had quite a bit of experience in building businesses or investing in businesses. There are people that have already built very big companies in the Hunter. Some that have made a lot of money in the mining industry. There's a couple, for example, different people that sold out of interest in coal mines, and you could say that they've got tens of millions, if not hundreds of millions, to invest, that sort of level. So it's probably obvious to you, but there is a lot of sort of hidden wealth in the Hunter Valley. And some of that, I'm not saying we're the repository of all wealth in the Hunter, far from it, but at least a number of the people that are involved with us have money, good industry experience, and that can be a benefit for people.
So is it, don't take this the wrong way, I'm not taking the piss, but like in there, I've got Shark Tank type.
Yeah.
Do you see that show?
Yeah.
Is that obviously a highly dramatized concept?
Yeah, well, they've got, Hunter Valley is a smaller area, right? I mean, we've got to live in the town, and so I think above all we try to be courteous in our process, but we also need to get to the point. So if somebody's not ready or whatever, we're not going to persevere with that. We have too many opportunities coming along all the time. So we'll tell people pretty quickly, basically you're wasting our time, or no, we think it's a great idea, but you need to do that, or we love the idea. And so it is a shark tank in the sense that, of course, we have to be very direct. And I would say that if we're not direct with you, others are going to be direct with you pretty quickly. So you might as well get, toughen up pretty quickly, to the because people pick holes in things pretty quickly if you don't have your act together. It's like going to the bank. If you don't have your act together when you go to the bank, well, the bank's got to be direct with you, right? Don't waste our time. You need to do this.
So have there been any opportunities that you've not taken up in that process because it didn't meet your requirements that have then gone on and been very successful? And
oh yeah, there have been a number that have escaped us. And
you didn't knock up a stupid idea called Google, did you?
I'd love it, wouldn't it? I'm pretty philosophical about it actually, because you can only go through a process, right? You can only sort of say, we think this is not suitable or whatever. I've even not participated in some investments that others within Hunter Angels have invested in because I just couldn't quite work out how it was going to work, or that there was a real need for it. And I've got to say, one of them was one of the more successful investments. It hit the ground running really quickly. It's doing really well. I missed out. And I groan about it every now and then, but I mean, you can only really make an assessment at the time, and the other element about it is to try and spread your risk. Try to get involved with the good ones where you can see it, but don't put too much money into each one, so that hopefully that 1 in 10 multiple that we talk about just pops up, and you've spread it enough so that you've got enough irons in the fire that it can work. But it doesn't always work.
And a lot of the proposals that are coming, are they like digital sort of?
There's a
now, do you think, or?
there's an opportunity that's coming out of the university tonight, for example, that is related to an application that's a more rapid method of determining the compounds of substances, and that's got a great opportunity. There's a couple of others in the digital space. So it varies a bit, but it tends to be more sort of digital-based applications typically, but it doesn't have to be. Righto. Well, look, I think that thanks everyone for listening. Unfortunately, I can't get involved much with. In fact, I've probably spoken way too long, and I have to move on for that presentation I mentioned this evening. So there is a case study which I've been involved with preparing at least a couple of the case studies, and we've got a handout for that, which is really just those couple of slides I showed up about what angel investors are looking for. So what I'm suggesting, when you look particularly at the first 2 case studies, you might give some thought to that list that will be on your tables, and in answering the case studies. So I'm going to have to go. I'm sorry, everybody. Thank you.
So, debt funding a business is large and small. Some debt in a business is sensible, a lot of debt can be dangerous. So look, I suppose the a lot of debt can be dangerous part is pretty self-explanatory, but in terms of some debt in a business is sensible, of course, as a bank we like to say that, but I suppose if you do any sort of corporate finance or any sort of accounting sort of background or studies, you'll know that leveraging assets, etc., is beneficial. You get the cash out of the assets and you can invest or keep your operations going. So as I go through this, I'll probably use a heap of examples of my own customers. I've got one bloke who is very wealthy but tends to pay cash for a lot of his vehicles. He's in earth moving and sort of all these other sort of funny industries, but he pays cash for these trucks. And occasionally you run out of money, and I'll go, well, mate, you should just get us to fund these $100,000 trucks. You pay us a little bit of interest per year, but you've got your 100 grand out to do what you like with, invest, do whatever else you are doing. So I suppose that's kind of what I think about when I read that sentence. It's about leveraging assets, whether that be property or plant and equipment or anything of that nature, even your debtors, which I'll talk about in a sec, to make best use of the equity or the cash or value in your balance sheet. And you know, cash is king, as Grant just said, so it's about investing that in the best way possible. A lot of debt can be dangerous, obviously. You know, the bank doesn't want too much there. We want to make sure you can pay it off over a period of time at a distressed interest rate. So, you know, I think that's pretty self-explanatory. So, if you remember one thing from this session, it should be, I guess, growing sales does not necessarily equal growing profit, does not necessarily equal cash, and therefore doesn't equal success. So, this is kind of banking 101 or something that is heavily drilled into us at the NAB and the less experienced bankers, where people or inexperienced, I suppose, business owners think, oh, look, I'm selling so much stuff, this is great, I'm killing it. However, unless certainly the profit's there, then you know, you're not. And then definitely cash. So we see it a lot in business banking where businesses might have a pretty strong P&L and it looks like they're going pretty well, but they're coming to us for an overdraft or more money, and you say to the guy, well, why? And yet they often have no idea in the less experienced sort of space. And it's not till you dig a bit deeper and you look at certainly the profit and loss, but the balance sheet, that you see that the cash is tied up in the balance sheet and they're not making cash. So I've got a great example right now, and I'm talking to my credit guys in the bank. This is a very large business, very successful, but they're on pretty high growth. They turn over about 25 million. About 2 years ago, they probably turned over 10. And their profit and loss for the first 6 months from June to December showed 2 million. All right, so great, they're making shitloads, but no, they've got now, they owe the taxman 500,000 because they're not meeting their GST, PAYG, that sort of stuff, and they can't amortise their loans that we need them to amortise, so there's a huge cash problem. So when you dig a bit deeper, you can find that a majority of it is tied up in inventory. They've probably got $8 or $9 million worth of inventory on their balance sheet, and that's probably, you know, not doubled, but grown considerably over the last 6 to 12 months. And so that's where the cash is. It's in the inventory on the balance sheet. And so we'll work through them. The business is still very strong fundamentally. We'll just now manage I suppose the ATO arrears, which is a big red warning sign for the bank, but we'll manage through that. Certainly supporting the business. They're not sort of a danger to us. However, they've got no cash. So people will often think, oh, look, here's my P&L, I'm making a lot of money. Generally in business banking, we will assess your ability to pay us back on cash. Now, there's a couple of calculations that are not really relevant here, but it's generally what is your profit and then what is the movement in your balance sheet items. Key ones are debtors, creditors, equity, internal loans, that sort of stuff. And that's what spits out a number that we call net cash after operations, and that's what is available in that year to pay back the bank, essentially. So, as I said, it's probably not something everyone would normally think about, but definitely that's what the bank is concerned about, is cash. Cash pays back debt, not profit. It's probably the key takeaway from that. Okay. So this paradigm relates to the interaction of the following: cash sources, asset conversion to cash, cash cycle, I think that's very similar, and repeatability. So cash sources, I guess, and Trish, feel free to jump in here if I miss something. You know, I just sort of went over those things. Sales is the big one. When we go through and look at these sources of cash, sales, obvious, gross margin, obvious, or cost of goods sold, expenses, obvious, in terms of what sort of impact they have on cash and then for profit. So some of the ones people don't think about are things like debtors, creditors, or more accurately, debtor days and creditor days. How quickly do you pay them and how quickly are you paid? And it's amazing the impact that can have on a business's cash flow. So even paying and look, sometimes in the real world this is not possible. You know, you can say as a banker, I can say to a client, look, if you just got your debtors in a bit quicker, you'd have all this extra cash. And obviously in the real world, that's not always possible. I mean, I'm sure they would love to all get paid within 14 days, but no, it's taking them 70. So, however, it can be a difference of a couple of days here and there. Generally, you can see the impact pretty obviously that has on cash. So it's important for a business owner to be pretty well in control of those sort of things. And as a bank, and when I'm assessing a deal, I'll say, look, they've got great management over their debtors, great management over their creditors. Okay, it might be tight here, but we're pretty comfortable with the management because they are doing these things very well. And that shows us as the bank that they understand sort of the impact that those swing factors, we call them, has on their cash. And you know, a big part of banking, which I'll go into in a minute, is character and the people. And some people might think it's very black and white and we just look at the numbers and the security, but you'll be surprised to know what our credit managers drill into us is character is number one, and their willingness, I suppose, to repay us is number one. So if the guy is a good operator, honest, upfront, conservative, then you know we can go a bit greyer in some of these other areas, and that's what happens. Business banking is a lot different to personal and home loan land, where there's far less shades of grey. In business banking, you know, policies, in my view, are made to be broken. That's how I roll.
Can I ask a quick question?
Yep.
What does your bank consider good management of debtors in terms of days?
Well, it's industry specific. So some will be very short, some will be 30, some will be 60, some will be 90. So it's very much industry specific, and they're the sort of things that we will look at and take into account when we're assessing a deal.
Do you look at it against, say, business A has standard terms of 30 days and their average is 45?
Correct.
Or, you know, or ours is 7 and they're getting it in 30 or something like that?
That's right, and mate, that might be a cause for a discussion. And again, part of that character piece, and very much what we do as a relationship bank at the NAB, is try to really understand the business. Now there might be valid reasons we can look at certain industry research and have a look at what the industry standard is. And if they're well above, you'll say, well, what are you doing? Are your clients sort of having a laugh and treating you like garbage? And that's a bit of value we can add, I suppose, in that sense to some less experienced business owners. But yes, it's generally looking at industry trends or benchmarks and seeing where they sit in that scale. No real hard and fast rule. But another interesting example is where a business is largely cash and they have no debtors. And we'll get, this is on the smaller end, like a coffee shop or something will come and say, I need an overdraft. And you go, well, you really don't need one because you get paid cash on every transaction. So you don't have this, and we're about to get to it, the cash cycle. You don't have this hole where you're waiting for your debtors to be paid to sort of fill the bank account again and continue on. So it pays to be a little bit savvy as a banker because the customer or the borrower will try to have one over you a lot of times and tell a story about why they need this, but generally it's either to fund exorbitant wages or go on a holiday. Oftentimes that could be the case. So, as a banker, sometimes, as Grant said, we need to be firm and just say, no, it's not going to cut it, or you don't really have this cash flow cycle problem because you've paid in cash. So that is the asset conversion to cash and the cash cycle. So what we're talking about there is where you've bought, let's say for a business that has a lot of stock and they're selling stuff. So you buy the stock, your cash is out of your bank, right, from that day. Then you have stock in the warehouse, you sell it on 30-day terms, you get, then that's another 30 days after you've sold it. Who knows how long it's taken you to sell it from when it arrives in your warehouse. Then you sell it another 30 days and then you finally get paid. So that's, in very basic terms, the cash flow cycle. And that is often where an overdraft is required, okay? Or there's some other working capital type facilities we do. But that's very important. And having a tight management of that cash flow or cash conversion cycle or asset conversion cycle is critical to any business that has that sort of structure where they're either buying inventory or making things and selling things on credit terms. So that's where the whole comes through. And that's where generally people will go, I need an overdraft, or I need debtor finance is a good one, or I need trade finance. There's a couple of other products we would do if they're importing or exporting and things like that. And that's all about covering the working capital cash flow cycle to make sure they can continue to trade and manage these lumpy holes. And again, back to that other example that I mentioned earlier, where they've got no cash, it's because their cash flow cycle is very lumpy. And I'm talking $1 million will come in one day and then they'll have no $1 million for the next 6 months because they're dealing with very large sort of clients of theirs. So debtor finance, I just wanted to mention, is an interesting one, and that's something we see a lot these days in terms of how, well, we like as a bank in terms of how we can help businesses fund their growth. Most people would understand the bank likes to have a house or something behind us, right? We like some sort of property. That's the thing we can go and sell and get us out of trouble if we need to. But debtor finance, the beauty of that is that we gear or add or extend value to the debtor book. Now, we're talking not small numbers here. We wouldn't really even look at it for anyone with a debtor balance below $500,000 really. We could push it to 400 or 300 at a stretch, but usually it's that sort of size of a business. And using the $500,000 number, the bank would sort of generally say, right, yeah, well, we'll give you $400,000 against that $500,000. Not like factoring, if anyone knows what that is. That's sort of an old school way of doing it, where the bank or some other company will buy the debtors and then it's our job to collect them. That's not how debtor finance works. But it just means we have a charge and we take some comfort that if everything goes terribly wrong, we will recoup, most of our money back if we have to go after these debtors and get paid. So the reason that's great is certainly it grows with the business. So as your debtor book grows, so does the amount we'll give you to fund the cash flow working cycle. And secondly, it doesn't mean that mum and dad have to, or whoever it is, has to put the house on the line because they may already be geared up on the house just to buy the house or whatever, right? So you don't need, $500,000 of equity in a house for us to be able to help you out with the working capital line. So debtor finance is good for growing businesses in that sense. Means that we're not desperate for extra security because the debtors are the security.
So Tim, just to scale that one right back. So say in the example, you've got your customer who say sells TVs, and they've got $9 million worth of TVs sitting on the shelf, and they sell $1 million worth of them to a couple of clients, but they don't get payment for those for 60 days. So they're on 60-day terms. So what the bank does, we can say, right, well, you don't have to wait 60 days for your money. You can get 80% of that up front. The bank's going to sell that invoice. You sell that invoice to the bank. The the bank gives you 80% of that invoice, so they're going to give you 800,000 up front, and then when your clients pay you $1 million, that comes into the bank takes their 800,000 back, and you get the 200,000. So that's sort of how that works.
Correct.
The bank is buying the invoices from you, from
Yeah.
the client.
That's right.
Yeah.
But you don't get all the 200, right? Because the bank's made no money
We
there.
make a bit of interest,
Just
yes.
an
Yeah,
interest.
We don't talk about that. We don't talk about price, all right? We're here to provide a service and make dreams come true, not to charge.
Right.
So that's a good explanation, Trish. Thank
Yeah.
you. That is exactly how it works.
Yeah.
Repeatability, look, I guess somewhat obvious as well. It's about how often or how you can continue to do that and without having, I suppose, these huge lumps, and make sure that's how a business runs smoothly. Okay. So the question we face as providers of debt is, does the story make sense and would you put your money on the table? So again, I guess, and I'll talk about this character piece a couple of times, but that's a lot of what it comes down to. The character and experience of the person is huge in banking. Of course, the numbers and the security is important too. However, the character and experience is critical. And why are they doing it? So I guess a live example for me, I'm looking at a deal at the moment. This guy wants to buy a pub, $9 million. So I'm currently working on that with him. He doesn't run pubs. He's very successful in his own right, managing a massive sort of Australia-wide business. You know, he personally makes about $500,000 a year. So he's doing pretty well for himself. He's got $3 million sitting in his bank account, wants to do something with it. So he thinks, all right, I'll get into this pub. So the first question I had for him, and then subsequently when I'm sort of chatting to some of the guys in the bank who will, I suppose, approve this thing or review it, is why are you doing it? Firstly, we want to know why, because sometimes we do get these cowboys who have no idea what they're doing, and it'll all go horribly wrong. So, and getting into a pub is obviously, it's not the easiest thing in the world. We all know how they operate, I suppose. We all go there, but running one's a little bit different. So look, the story in this case is this guy's family has always been in pubs. It's always been one of his bucket listy things. He's about 50, so he's probably almost ready to hang up the boots because he's doing pretty well. He doesn't want to run the pub. He will keep the management team on. This is the level of detail we go into. I mean, the business is making about $1.2 million a year, so it's going to pay for itself. In terms of the pub, just again, this is getting down to the level of detail. $9 million. The bank will give you 60%, unless you've got some other properties you're going to chuck in. And so in that sense, he's ticked the boxes. He's got $3 million, we'll give him 6. He's got, the thing will pay itself off because it appears to be a very strong business. The key second question is, why are you doing it? What is your ability to run the business? Who's going to run it? He's not, because that's not what he does, but he will keep the management team on. So they're the sort of things, the sort of level of detail we go into to say, well, is this a good idea for the bank? And then comes back to that question, would you put your money on the table? And I suppose in that sense, in this case, you'd say, well, back to the character, this guy knows what he's doing in the sense that he's no goose. He's the general manager of a very large business that probably turns over $50 million. He's done a fair bit of due diligence. He's hired a hotels expert person to do his due diligence. So these are all the boxes that are getting ticked in my head. And without really looking at it too closely at the moment, I've sort of said, yes, well, I want to do the deal. Very, very much so. It's a good hit for my balance sheet. And now it comes down to price to a degree. So the NAB doesn't really, well, we like to sell ourselves on a bit more than sort of what we're going to offer as an interest rate. But when we're getting to those sort of dollars locally, and he can probably ask 1 or 2 other banks what sort of rate they'll give him. Now I'm sort of working on how cheap we can give it to him for. So that's a bit about how does the story make sense, I suppose. It's really, why are you doing this? What are you getting into? And we'll get anywhere from that sort of level down to a bloke who'll come in with his wife who wants to buy a couple of hairdressing salons or nail thing I had a couple of weeks ago. And it was just a bit of a hobby. He's doing quite well, wanted to keep the wife busy, so they just wanted to buy this, right? Now, an interesting example on that one was similar to what Grant was saying on a multiple of EBITDA, the value. I gave them a bit of advice on that because whoever was selling it just plucked a number out, I'd say, and it was about a 3 times multiple. Now, I said to them, I don't think that's right. I mean, anyone can go in and start one of these up, really. You get a space in Westfield, you put a little couple of beds in there and away you go, pretty much. So that comes down to the barriers to entry. Anyone can start at one of them, like they can do a fish and chip shop or a coffee shop. So on that multiple, I would say a 1.5 to 2, 2.5 at a stretch, unless if there's some brand value in there, is where that would sit. The pub, as I said, it was about 1.1, 1.2 turnover. That's about an 8 or 9 times multiple. Now that's, I believe, largely due to the barriers to entry and having a liquor licence. You can't just start up a pub because liquor licences and gaming licences are capped and tradable, and there aren't unlimited amounts of them. So in that nail salon thing, I basically nipped that in the bud and they didn't come back. So, and does it make sense? Look, she had no experience. I feel sorry for the bank who would have sort of funded that one.
So Tim, talking about the $9 million pub, what are the risks involved in that business? And then how do you mitigate those risks?
Well, good question, Trish. Look, that is, I mean, I'll tell you the first one that is obvious, and I've spoken to this guy at length, is that this particular pub does a lot of late night trade. So again, these are the sort of things we get into. You might think all we look at is P&Ls and stuff, but no, now I'm thinking about who's drinking at the pub at 2 a.m. So we used to have some experience in that, not so much anymore. But no, so look, that's probably the big one. They do a lot of late night trade, right? And obviously there are what we'd call societal or political risk where they might change the rules on them. Lockout laws might be in effect in this place or implemented. Late night trade's gone, and the pubs, suffers heavily as a result. So in this case, as I said, the guy is a smart cookie. He's doing that level of due diligence to try to find out what sort of proportion of the turnover or trade is that late night stuff. He doesn't really want to do that. It's probably making good money, but his long-term strategy is to probably follow what most people do these days and make them into a lovely food place for families, even though they still have the pokies. He's actually proposing to extend the pokey area, and I think that's just business, isn't it? That's what they're doing. But again, you've got that sort of societal or political risk that, people don't really like pubs that have a whole heap of pokies and become, gaming dens. So there's also those sort of risks as well. Now, I couldn't say I'm an expert in pubs, Trish. Except for drinking at them, I haven't funded too many. So that's the process we'll go through, I suppose, at the moment. At the moment, I've ticked some of the key boxes, which is LVRs are fine, loan to value ratio, I said the 60%. So it'll pay for itself, no problem, and he's coming from the right place. And then we'll go through some of those risks and address those in terms of mitigating. That sort of one, Trish, I suppose you'd say that he has a strategy in place to diversify away from that late night trade. And then we can sort of get comfortable that makes sense too. It's not pie in the sky. In fact, he's probably following the lead of a lot of other pubs that are doing very well on that strategy.
And so that's, I suppose, where a really good business plan comes in play. If he can present you with a great business plan of strengths, weaknesses, risks, things like that, that means then you can go tick, 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 tick.
Correct.
And it comes back to what Grant was saying before, is very similar in what they look for, that the angel investors look for, is very similar to what we look for as well.
That's right.
At the bank.
That's right. And I mean, again, in this sense, we can't all be experts at every industry. So we get valuations. Everyone knows we get valuations. Unlike a normal residential house, a pub is a fair bit more involved. But the experts in pubs who do the valuations provide a lot of that information for it. So we don't need to be experts in everything as business bankers. It's a bloody interesting job in the sense that we do get exposed to all these businesses and get a bit of an understanding of how they work and what's going on, and we get tours of their premises and all that sort of stuff, which is a great part of the job. But we rely a bit on the experts, in this case the valuer, for instance, to do his work, say what some of the risks are. He will also sort of say what some of the opportunities, etc., are, and they might often be mitigants to the risks. And we just sort of use a bit of that because, again, we're not necessarily experts in it.
So how much, for instance, take the pub example, if it's a really good opportunity for the price, how much, is there any way to sort of protect your interest or being gazumped basically while you're off doing it?
Well, I guess that's his risk. And in this case, the pub was passed in at auction at about 9.1. He went in at about 8.8. They said 9. Now they're at 8.9. I've just said 9 to round it up. So it's 8.9. Now he doesn't want to exchange contracts because he doesn't have the finance. I think it's pretty comfortable he'll get it, but there is that bit of risk. He doesn't know whether the valuation will say, no, this is only worth 8. And then our LVRs are all shot. Now, during this due diligence process, we can make some pretty educated guesses on what it's worth. And the way that they do it is go, well, pubs are selling for what they call a cap rate of 12% at the moment. A pub of this sort of size and quality, about 12%. So you go that sort of EBITDA, again, round numbers, $1 million divided by 12 times 100. That's sort of where it spits out a value. Those probably numbers don't really work if I just rattle them off, but that's how they will do it. That's how all valuations generally work, along with comparable sales and other things along those lines. But yeah, so look, in that sense, he's probably got around the right price at the moment, so we're not too concerned about the val. However, he doesn't have an approval. So what he's signed is a heads of agreement with the other guy and goes, right, I'm keen, but I just need to get the finance. He'll probably buy himself 4 weeks. So now it's all systems go at the moment. I've told him to go instruct the valuer himself, and because that's usually the thing that takes the longest. When we get that, we'll be about 2 weeks away from approving it. So yeah, so that's his risk really. Some people will exchange contracts and take that risk before having finance, and it's sometimes what they have to do to be able to get an evaluation. The bank doesn't want to get a val until we've got an exchange contract, because we can't be seen to be giving them advice on what the price of this asset might be. If they want to go and get that from a valuer, they can, but we can't be involved in that sort of thing. It's a bit weird.
But there are a couple of things you can do to try and cover that risk. So you can sign a contract that has a condition in there for finance, or you can get a pre-approval from the bank. So, well, this is what I want to look at. This is how much I want to pay, and we can provide an approval subject to valuation.
Tim, do you often find there's a big difference between, say, a private valuation versus a bank's valuation?
Look, a little bit. Houses are a little bit different too. So the bank will do it for mortgagee purposes. It's a technicality that valuers are then obliged to follow certain rules. Their PI insurance probably has some impact on what they can and can't do. But yes, oftentimes we'll get a valuation. It's a terrible part of banking is the valuations are a massive issue often, and usually on houses, right? Not so much commercial properties and businesses. Where our valuation, for instance, I've got a prime example in Redhead, was about 900. He went and paid for his own valuation at 1.3. So, he was pissed off, and I said, I understand, mate, but we can only do what we can. But yes, usually for mortgagee purposes, they're far more conservative than perhaps for stamp duty purposes if you're selling it or selling it to a related party and things like that, or if you just want your own peace of mind that you're sitting on a great house that's going up. So yes, they usually are. So whether it's providing 100k or 100 million, the fundamentals are the same. That's exactly right, and it goes back to my comment about the nail salon. It's exactly the same. We go through the same process and sort of cover the same territory. Sometimes the bigger deals are easier because usually they've got more money, they've got more security, and they generally, I find, easier. So the 4 C's: capacity, collateral, character, and conditions. So I would put character at the top, and so would the NAB. As I said, that's generally number 1 for us, and their willingness. Personal character, history runs on the board is number 1. Obviously, if we've got a huge hole in these other areas, we've probably got a bit more trouble, but number 1 is character. Now, an example of that was for me last week. Probably the most borderline deal I've got over the line was last week, and based 100% on character. So this guy is a property developer. He wanted to go to an auction. $2 million he kind of thought he would need. And when I did the numbers, the collateral was fine, so that's the security. What have we got in terms of what's sitting behind it to sell if we need to? What are the LVRs like and all that sort of stuff? We ticked that box. The big hole, however, was capacity, which we're saying here is primary exit. What is our number 1 way to get out of this that's generally being repaid? Ability to repay cash from ordinary course of business. So in this case, that was non-existent, right? So he could barely afford to cover the interest on all of his debt. And obviously in banking land, that's not enough. We want to have a bit of a buffer and we want to show that they can pay it off. But being able to just cover the interest, and I was pretty light on his living expenses, for instance, so he might have had to live off, baked beans and 2-minute noodles for a while. But it was borderline, okay? So the reason that I backed him into this deal was twofold. One is his character. So I've probably done 3 or 4 little projects for him where he's built 4 townhouses. He is a builder, he's an owner-builder sort of guy. But he's very level-headed, careful approach. So some builders are, pretty interesting characters. This guy is very clever and, it's a bit different to your average builder. And so, 3 successful projects, no problem. So I know he's got the runs on the board with us and he's demonstrated that time and time again. But what was I saying there? Oh, the capacity was borderline. The character was there in that sense. So what I basically got him was the approval. $2 million, go for it. Good luck at auction and have a crack because hang on, now I'm getting back to what I was saying. The risk for the bank was that he wouldn't get a DA on this site. Primo spot down just behind Derby Street. He was going to put 6 townhouses on it, but no DA. So there's a risk there for the bank and it was vacant, so not generating any money. So the risk there, the bank is like, well, if he gets no DA, he's got to flog this thing that he'll make nothing off. Because he can't get a DA, neither probably can the next bloke. So there was a bit of a risk there. However, we, I guess, successfully mitigated that risk by referring to a town planning advice and stuff like that, all these things he went and did, again, character, to show that it was less risky. So my pitch to the bank was, look, the likelihood he doesn't get the DA is very, very low. I'm willing to back this guy on that because he's a smart guy and he's done his due diligence. I believe he will in 6 months. So if he can just keep his head above water for 6 months, he will then get the DA, we'll go into a construction phase, which is when we capitalise the interest, okay? So he doesn't even need to pay us. We'll give him the extra money so that he doesn't have to pay interest for the 12 to 18 months that he's building these things. So that's all the pressure comes off then. The pressure is on at the start when he's holding this site without a DA and not building anything. So anyway, long story short, as I said, very borderline, got it over the line. He was very, very appreciative, and that's one of the things as a banker, you do get those little moments where you feel pretty good about yourself, because I've really helped this bloke. Like, he was going to make $2 million out of it. I say it was because he didn't get it at auction. Through our discussions, I said, mate, yeah, he was going to make 30% out of the deal, and long story short, that means the land is worth more than $2 million. I said, mate, I think it's worth more than that, but I was only prepared to give him 2, and that's all he really wanted to spend. Anyway, I went for 2.7. He didn't get it. But, as I said, that's the perfect example of a couple of things. One, where character is the way to do it. 2, where you don't necessarily follow policy if you're a good banker. And 3, where, as a banker, you do get these little moments of joy when you help people. And, you know, we do somewhat help people change their lives in that sense. So, I think that's it. So, questions?
I was just going to ask, like, for the EBITDA multipliers to value businesses, is there like a place that general people like us can go and find those? Or?
Look, there's no hard and fast rules. It's just really what the market will pay. And as I said, the way that I generally sort of use it, I will generally base it on sort of what we see. But it's really how hard is it for average Joe to go in and do this. So that's why I use the coffee shop example. That's easy. You got to buy a coffee machine and set it up in an empty shop, and that's your coffee shop, right? So anyone can do that. Obviously, there are other factors like foot traffic, brand, where is it, that sort of stuff. Obviously, always would create a bit of value. If you've got the best spot on Derby Street, then you've probably got a better EBITDA because you have the location. But in very broad terms, as I said, the nail salon in Westfield or wherever, they're everywhere, kind of. I don't really notice, but I feel like they are. So, you know, so there's sort of things where I would say is a very low multiple. Back to the pub, you've got a real reason why they're rare is because of the liquor licence. And anything, as Grant said, which has high growth potential will generally create a higher EBITDA multiple. So a business that might want to acquire another business, that it can then leverage their IP or whatever they've got to grow, again, that creates higher EBITDA multiples. There's no real rules or list anywhere, mate. It just comes back to what the market will pay, and that's the same way that, that's a way that business are valued. It's the same way that commercial properties or pubs are valued, on those sort of yields and what the current yields and what's the appetite for those things at the moment. Yes?
When do you think the interest rates are going to go up?
Shortly. No, look.
8 times in 4 years.
Yeah, that's right. That was in the papers.
Yeah,
look,
I read that 8 times in 4 years.
In banking land, there's a hell of a lot of pressure at the moment in home loans, and it's all driven by APRA and regulations and the capital cost and making banks stronger, really. And obviously taking the heat out of the investor market. So that's the big one at the moment, and just recently, I hope this isn't publicised because I wanted to keep it on the down low, but the NAB has raised its interest-only rates for investors. I think all interest-only rates have now raised for anyone who has a home loan that's interest-only. And the purpose of that is to, again, discourage people from doing it because we want to see our exposure generally come down and all the banks will get a stronger balance sheet. But it's to take the heat out of the investor market so that it's not so lucrative for people to go and take a massive negative gearing effect, make a massive capital gain at the end, and everyone's loving it like they have been for the last couple of years. So, look, you know, it's possible the RBA will raise them, but banks may do it out of cycle for these reasons. Commercial rates, however, don't usually move in sync with that, and they have been creeping up.
Yep.
I think a really good indicator is the business lending fixed rates. So they generally move ahead of what happens with the floating rates. So the fixed rates are actually moving are above the floating rate, whereas 12 months ago we saw that the fixed rates were below the floating rate, so you're getting good value for fixed rates 12 months ago. But we've seen since August last year, they've steadily increased and gone above the floating rate. So that tends to be a good indicator of where the market thinks rates are going.
How much equity usually needs business line?
Depends what value is in that business. So if we're going, if someone wants to buy a business,
$1 million for the business, how much equity do you generally?
well, I'd say what is in that, what value is in that $1 million? Is it all goodwill because you've got a lot of, you know, because it's just a brand? Or is there assets on that balance sheet that the bank can say, well, look, again, if everything goes bad, we can sell these assets, like it might be a trucking company, right? And the $1 million is because there's $1 million worth of trucks, we'll probably lend you a fair whack of that because we actually have some sort of security. If it's nothing and you've just sort of got a good name out there and you take orders and you do stuff, but you don't really have any assets that we could go and sell, then the very best usually is around 50%. And we have to have a pretty good reason though to do that as well. So I did one for a very large business we'd all know. I can't really probably name names, but I got that away at 50%. The directors are worth a fair bit, so we got them to guarantee it. And they're very rich and asset rich, so we got relatively comfortable. It was a reasonable punt. Business has been around for a long time, made bloody good money. We're okay at 50%. That's a very good business. I had another guy do a similar thing for a business and we said, no, too risky, nothing here, and you could just walk away and we're stuck. Because there's no skin in the game, we call it. The bank wants skin in the game always, and 50%'s a bit of skin, I suppose, but that's where we start. We wouldn't be at sort of just chucking 20 and the bank will own this business. The bank's not in the business of owning businesses that we don't run. So it all comes back to assets. And again, banks will gear against assets in a balance sheet. So this example where I said they had $8 million worth of stock, we call that $2 million to lend against, 25% usually. So we go, look, if everything goes really bad here, we have to start selling this at a fire sale, we might get $2 million back. So we'll call that $2 million and I can give him $2 million overdraft if you needed it.
How different are the interest rates in the commercial game compared to?
Well, this pub deal, as I said, will be bloody competitive. So I'm going to give him a rate probably lower than most people's home loans here, but typically they are higher. And back 5 years ago, they were a fair bit higher. Over the last couple of years, they've compressed commercial rates, and I think that's just a factor of competition and money being pretty cheap, and there's a hell of a lot of activity out there we all want to crack. So the gap is not so far. And so the very good deals, you know, the banks, like for instance, this one I'm offering about 3.97 for $6 million. For a property development deal, that'd be about 5.5. Okay? And your average home loan is probably between 4 and 4.5 for an owner occupier, or maybe a fraction below 4 if you're a good negotiator. But yeah, so they're closer than they probably ever were. And for the right deals, banks are really going sharp. Like 3.97 is unheard of. 5 or more years ago, you're probably paying 7.5. So yeah, that's about the spread. Now, as an average deal, 5% I usually quote. If I could sort of take it or leave it, I'd say 5%.
It depends on the product too. So that's a term loan that you're talking, whereas an overdraft you're looking at 8.5%, 9%. Your debt finance facility you're talking about is again 8 to 9%.
That's true. So they are different.
Equipment finance 5 to 6%.
So what's the term on the pub deal?
What we will do is give him a 3-year term, and the reason for that, again, it gets complex, but the bank buying 3-year money is cheaper now than buying 5-year, or usually always is, 10-year, and that just dwindles our profit. If he wants a 10-year term, which I might give him because he's an owner-occupier, then the rate will go up. But if he wants 3.97, you'll be getting a 3-year term, and what would happen after 3 years is we just have a chance to review. The bank technically has an out, and if it's all going shit, we'll say, well, we're out, buddy. You had a 3-year term, we're not refinancing this. So that is a bit of an exit opportunity for the bank if we need it. But the main reason these days is cost of funds are cheaper at 3 years, so we can give better rates. Usually though in commercial lending land, if someone wants to buy a commercial property and it's got a tenant on a 5-year lease, we won't give them any more than 5 years. We want to match lease term to loan term. Or if they've got a year and a half on a lease and they go, yeah, but he's got a 3x3 option at the end, too bad, year and a half is your max term. Right, that's the bank again mitigating its risk. The tenant bails and we're left with an empty property that's got no rent coming in.
So do variable terms exist for investors?
What do you mean variable terms?
Like a variable rate?
Yeah, absolutely. Yeah, so businesses will always have the opportunity of variable or fixed rates. Bank loves fixed rates because it means you're sort of somewhat protected from leaving us because you've got to pay off a break cost. And that's not a horrible cost that the bank charges as a penalty to say screw you. It really is the actual cost to the bank, because we buy the money. Let's say we buy $1 million today at 5% or whatever. That's the cost to us. If rates then go down and it's 4.4%, and you want to get out because you're paying 5, then we've bought the money at 5, so we're not just going to let you walk it because it's 4, because of course you want to get out, because it didn't go the way you would hope. However, the flip side of that actually is if you fixed at 5, all of a sudden rates are now at 6 or 7, and for whatever reason you want to get out, you probably don't want to because you're loving it at 5% while rates are at 6 or 7, but if you did, the bank would pay you money. It happens, where you get paid an economic benefit, they call it, and rather than calling it a break cost, it's actually called an economic cost. That's probably the nice way, but yeah, it does happen. If you had to sell, or you split up with your wife and you had to sell the house and you were loving life at rates lower than the prevailing rates, you get paid out. We actually pay you a benefit. Now, look, Grant went for ages. We're going to do a case study thing, so we've got no time really, so we're going to have to skip that.
We'll have to network.
I think I'm going to have to network. Look, the point of it was, and it was handy to have Grant and Steve here, but what we had was a couple of case studies. A few were actually real